Good morning and welcome to the Saxo Bank Morning Call. It is Friday, March 15th, and we've got not so much about the moves in the market overnight, but we have an interesting policy speech from China's Li Keqiang pointing at what their focus is policy-wise as they're moving to deal with a clearly slowing Chinese economy. The focus seems to be on the supply side, tax cuts, and on spending rather than on necessarily big moves in rates. Steen, what's your overall impression on this, the signal we're supposed to get from this policy mix?
So what is uniquely interesting is that it's all about MMT. So they're going to try to reactivate the Chinese economy through using the tax as the incentive, which is massively interesting because, of course, that is a classic supply-side way of doing things. The second thing that is, and at least for investors, must be very, very interesting is the fact that we have the president saying we're going to play to the market players. In other words, you have an official of an established leadership in China saying that we will support the market, we will make sure the momentum goes into the stock market. So what I think is setting up right now is a couple of things, and I think Althea will touch on some of them as well, is that China right now is trying to take the froth out of the property market, and they want to move sort of the, let's not call it speculative, but the investment capital of China into the equity market, and the equity market will be seen as a barometer of how well the Chinese policy is doing. But at all times, the main point for the Chinese CPC is to maintain full employment.
But it's also maybe perhaps the equity focus encouraging investment in companies and the private sector more than sort of this brute force economic development through property and infrastructure, perhaps.
Yeah, and in that you actually have a built-in conflict because I think at the end of the day, Xi Jinping and the CPC do not really want to give away more to the private sector. But in order to solve this equation of need for more stimulus, need for more capital, without increasing the amount of debt, you need to focus on the equity market. You need to share the burden of the investment with foreigners. Hence, this massive inflow that Althea would touch on is coming in both in the bond market but also in the equity market.
And interested in bringing that inflow. I've got a few charts here. First of all, let's look at the RMB. We don't have charts, okay? We have a couple of focus points. Althea, on the bond market side, you're noting that across the yield curve, bond yields are coming down, and you expect that trend to continue.
We're talking about the Chinese yield curve, right?
Yes, the Chinese sovereign bonds and the Chinese yield curve, yes.
Yes, exactly. So what's happening is that the Chinese government bonds have been the best performers for 2018. Just to give you an example, the 10 years Chinese government bonds has rallied from a yield of around 4% at the beginning of 2018 to around 3.10% at the moment. What is happening here is that now investors are asking whether this rally will be supported throughout 2019. But I believe that, as Steen has just said, we very much have the potential to see that throughout 2019, not only because the PBOC is supportive of the economy, but also because China is opening up to foreign investors. And for a legislative meeting that we had yesterday in Beijing, we have seen that a law has passed that should guarantee equal rights to domestic and foreign investors.
Some of that perhaps as well, Steen, wouldn't you argue part of this whole negotiation ongoing between the rights of, or how capital is treated in China, how foreigners are treated in China versus in terms of the trade deal?
Absolutely. It fits the bill on what the U.S. is demanding. So I think they are playing a two-sided game here. They're playing to the domestic audience, and at the same time they're playing to the... But, you know, the leadership needs a success. They need the equity market to go up, basically. So in my equivalent, this is like in 2018, you remember, John, that we had the buyback program fueling the equity market in the U.S. It didn't really matter fundamentals. To some extent, this buyback program, 2018 U.S., is in 2019 being replaced by the buyback equivalent, which is a state-engineered monetary support combined with a inflow of capital to it. It doesn't mean it can go up infinitely or whatever, but at least as a relative trade, China should be able to outperform.
And a lot of the implications as well. I'll say on these, there's the MSCI. We've talked about that reweighting in equities, but there's also a focus on bond weightings as well. And there's some news on that front that could encourage capital flow into China, not only from a policy perspective, but as we're all talking about here, the capital inflows.
Yes, we are seeing as soon as next month the Bloomberg Barclays Global Aggregate Index to include the Chinese government bonds. This will mean that a lot of real money will start to invest into China, and it seems that there are already talks on the way for the FTSE Russell Government Bond Index and JP Morgan Government Bond Index to include also these securities. So what we are seeing now is basically the Chinese bond market or the Chinese market in general to open up to foreign investors, and as soon as we see this flow coming in, we can expect a rally.
Yeah, my problem with that, and these are very important points. My problem is that you still have a country with the capital control, so it's sort of welcoming capital in. Your capital will be supposedly treated well, but you still have a capital. How do you deal with this sort of I would say the tension in those two issues?
Once you think that's a planted question, John, but actually what's interesting about Bond Connect is that it's out of Hong Kong, so you're under Hong Kong regulation. So actually using Bond Connect, you don't actually deposit the money in China, you deposit them in outside the system. So that's one way to do it. And the Chinese authorities are very well aware of, when I meet investors, not only in Shanghai, but also in Singapore and people who are interested in China, the question you are raising is the question they also raise. There are really free ways to access this market. Bond Connect, which gives you a Hong Kong regulation, the direct access to the interbank market, which means that you put money inside China, and of course the qualified investment program, which has been in place for a long time. But what Bond Connect does is that it creates more liquidity supported by the Chinese government, and it gives you the rule of law of Hong Kong relative to the Chinese law.
Okay. And it's very interesting, John, because Saxo Bank has actually just launched Bond Connect. So right now clients can go through our platform and simply pull out a ticket of a Chinese government bond and open a trade ticket and quickly trade it online. Right. It's very easy, so we invite everybody, all our institutional clients to try this online, and if you have problems, just please contact us.
Great. Access on the Saxo platform to Chinese bonds. All right, let's get back to the day-to-day here. We've got equities at very interesting resistance levels. Once again, the S&P 500 at 2,800 plus area that has been sort of the resistance all the way since back in November. I'm wondering, a lot of this may be some buying related to the quad witching. There's certainly a lot of, a lot you can find on that front. That some of this buying is about the witching hour coming up today, and about this pre-buyback, what's it called, buyback blackout period before earnings, etc. Steen, it doesn't seem to be really any connect. There seems to be a disconnect between the bond and the equity market. That they're both trying to rally at the same time. Surely one of them is wrong.
Yeah. I mean, correlation works until they don't work, but I think in this case, I think there's still a risk if you look at which we can't show right now. But if you look at the chart, there's a big risk that we break up. But I don't actually think it has any momentum, because you can argue it should already have broken if it wanted to break. But I still think there is enough interest in the market, enough momentum, and incoming, of course, also is that by end of April, we're still having this carrot, which is that the trade deal will be announced. Yeah. I do happen to think that the trade deal will be your catalyst for selling. So I will probably personally sell the FAC and just await what goes on, because until then, we will, as we have seen constantly over this year, have positioning by the Chinese and the US to create at least the rhetoric victory of having an announced trade deal. I think everybody by now knows and realize that this deal is pretty much just a piece of paper that both leaderships in the US and China needs.
And the economic cycle is the economic cycle that was already in motion before, the whole trade issue came up. So,
straight up answer to your question, I think the bond market is right. I think the US data is slowing. Atlanta Fed is getting into negative territory. It is not a fully predictable forward-looking one, but it's one of the better. So at least in terms of direction, we are slowing down in the US, so the bond market should reflect by higher rates. And I think ultimately the equity market has to reflect it by expected less earnings. I still think there is an earnings recession news in the US. But clearly the market right now don't even want to talk about it. I mean, leave alone trade on it, but talk about it, they are ignoring it. And for good reason, because technically they're still in the driver's seat.
Okay, we're still without charts as far as I understand, so we'll not show the chart here, which is actually rather boring, of sterling. But of course, we need to cover the latest developments we had yesterday, the new vote that will, firmly we've avoided the no deal, the Prime Minister getting defeat on that front, that they're very firm Parliament in favor of avoiding a no deal, and her latest gambit will be to vote once more on her deal before next week. This is May's, I think, last chance to remain in office, if you will. The implicit threat being that if they do not vote for the deal, it opens up UK participation in the parliamentary elections and risks this short delay, which was the original plan, becoming perhaps even a 2-year delay, which could lead to elections, which could lead to a second referendum, etc. So I think we're sort of locked in a range. Sterling's still higher, below that key range, 86 or so against the euro. I just feel the risk, Steen. I don't know if you agree that this ends up being a longer-term process unless May's deal. It's either May's deal passes or we end up in a very long road.
I think, first of all, I think May is out inside the next 3 months. I think, secondly, it's going to be a long delay because the European Parliament, which needs to ratify any short-term deal, goes on holiday or goes away to deal with the European parliamentary election by Easter Thursday. So we have only a week or two, and it's physically not possible. Think about it, we are still having a UK parliament that doesn't know what it wants. It knows what it doesn't seem to want, but it doesn't know what it actually wants. Yeah. And I think there was a list of defeats that Miss May has suffered yesterday, and we are talking about 35 ministers resigning. She's lost every single vote. She had the biggest negative vote on her deal, and she continues to come back with the same deal. If this is not the definition of insanity, I don't know what is.
Is to try to get leverage over these Tory skeptics, saying, look, it's either this deal or we end up perhaps never having Brexit at all, I suppose. But we'll see very soon. I think the end game swinging into gear if that vote does fail next week and we end up with that longer-term delay scenario. There was a BOJ overnight. I won't cover that. It was rather boring. Interesting, the comment out of that was Kuroda saying that he felt that MMT was a, quote, extreme idea. I think this is a bit ironic from the central bank that has launched the most aggressive, accommodative easing programs and failing, and essentially needing to switch to MMT if it ever does want to see inflation. Elsewhere, I should say, NOK rallying. Crude oil is strong, risk appetite is strong. Nordisk Bank, unlike the whole rest of the world, is looking at a potential rate hike next week. That is what the market is beginning to price. Technically kind of interesting for a further fall here. And next week we see if it can open up Euronoki, the territory towards 940, if it can break down below about 965 or so on the chart. Then I want to take it to the calendar. Not a whole lot going on today. We have the first Empire Manufacturing, the first regional manufacturing survey out of the U.S. We have industrial production and capacity out of the U.S. as well, not a big area of focus. But it's next week, it's all about next week, and I really feel the markets need to look towards next week because we have an FOMC meeting. The market is aggressively looking for that dovish turn from the Fed. If you look out, even 10% is already expected for 10% likelihood of a rate cut already in June. We haven't even stopped QT, and there's 10% likelihood in June of a rate cut. And up to 25% now for the December. Do you feel like the market is gunning for a dovish message on QT next week from the FOMC or for the Fed to move further towards accommodation?
I think at the moment the bond market in the US is pretty much dovish, and we can see it as the 10 years yields is around 2.6%, and in the past few days has lowered a little bit. However, there are still some rumors that the Fed is considering rate hikes at the end of this year, which I believe that at this point, also as Steen has mentioned before, is not possible. I don't think that at the moment the market is seeing anything dovish for next week. I think that they are rather positioned on the dovish side.
Isn't Steen? Don't you think it's all about the QT? At least, I mean, certainly in the near term, that is the key. That was, I think, the key language change or the key stance change that really triggered the comeback in January and risk appetite.
At first, it sort of indicated neutral was the right, we're getting to the right level, and then the QT became the issue. But the interesting thing is you have to remember, academically, Federal Reserve does not believe that QT actually does anything to monetary policy. There's been a number of papers coming out of Federal Reserve indicating that QT cannot have the impact it has on the sentiment. So it's always this gap between what is academically by the Fed considered to be an issue.
And the reality of liquidity, maybe?
And the reality of a guy who sits in a treasury position having to do repos, his access to funding, access to regulatory bonds that fits the requirement of capital requirements. So yes, absolutely there. But I think the market is already, fully, as you say, dovish, with the dovish tilt. And despite the fact that I think US data is incoming weaker, I do think the market is overestimating the ability of Fed to cut rates. And I also think, to the point that Fed should be hiking in December, I don't think the issue with December is that Fed cannot hike. The issue is it's right in front of the election cycle, which I think is going to be very, very difficult. So I think if we learn anything about the Fed this year is that they are they have a higher beta towards what happens in politics than we perceived.
They're the dog that is getting wagged by the tail.
They are definitely influenced by the political environment and the criticism they see not only from Trump but overall in the press, which is pretty sad, to be honest, because the whole independence is. It's not
Volcker. It's not Paul Volcker sitting at the helm of the Fed.
No, he would have been fighting still. I mean, this been Paul Volcker, he would have been going ahead with his tightening of this, because the ultimate damage here from the valuation of the stock markets and the asset inflation ongoing, the fiscal expansion that is on full tilt, is negative for the long-term impact of U.S. growth and productivity.
All right, with that big menu of stuff to talk about today, we will wrap it up for today, and we'll be back next week with the Saxo Bank Morning Call. Thanks for joining.